Last week headlines screamed, China bans Australian iron ore imports. Most outlets filed it under trade spat. I am here to argue, zoom out. What we are witnessing is not a friction, but the groundbreaking ceremony of a new resource order. For 20 years, the global iron ore playbook read like a bad joke. China buys 70% of seaborne cargoes, yet sets zero price. Australia digs ore at 10 USD, sells at 130 USD. Chinese steelmakers earn 29 RMB, less than a cup of milk tea, per ton of steel. Miners' gross margin, above 90%, higher than semiconductors. Hidden in the fine print, the US dollar, an invisible middleman, siphoning profit from both sides. Call it trade if you wish, I call it institutional bloodletting. History does not crawl, it leaps at tipping points. Today, 4 green lights flashed simultaneously. Demand ceiling, China's property slump shrinks steel appetite. Supply pluralism, Simandou, West Africa, 4.4 billion tons of high-grade ore, starts loading this November. Monetary infrastructure, CIPS network covers 180 countries. 45% of ore can already be invoiced in renminbi. Negotiator upgrade, China Minerals and Metals Group, founded 2020, merges 300 mills into one purchasing fist. Result, for the first time Beijing pulls the currency lever, telling BHP. Dollar cargoes halt, renminbi, welcome ashore. A single sentence, a 20-year-old iron plate snaps. Groundbreaking means uprooting old foundations and driving new piles. Pile 1, price pile shift benchmark from Platts USD to Dalian Futures CNY. Pile 2, pipeline pile, settle millions of tons via CIPS, no SWIFT, no US correspondent bank. Pile 3, profit pile, return the 15 billion USD annual dollar middle fee to Chinese mills and to Australian taxpayers. Remember, 70% of BHP's equity sits in New York and London. Canberra keeps barely 10%. De-dollarizing is not de-Australianizing. It is forcing Australian dirt to work for Canberra, not Wall Street. That is the new bedrock. Recouple resource rents with real economies. Iron ore is merely the first domino. Today ore is cleared in renminbi. Tomorrow LNG, copper, alumina, soybeans follow. Once 180 countries realize commodities sold to China can be parked in panda bonds, dim sum stocks, or Shanghai gold, the commodity, dollar, treasury, loop that underwrote dollar hegemony for half a century will face its first irreversible crack. The edifice will not collapse overnight, but it will never again return to baseline. Every shipload of ore is now redrafting the grammar of global trade for the next 30 years. Ladies and gentlemen, trade is about haggling, order demands groundbreakers. China brings demand as the shovel, renminbi as the cement, plural suppliers as the steel frame, and this autumn drives the first pile into the seabed of global resource markets. This is not an emotional slap, it is calculated institutional export. Watch closely. When the renminbi anchor sinks deep into the iron seam, the pricing tides of planet Earth will no longer be dictated by a printing press in Washington, but by the furnaces of the East, reforging the rules of the game. Thank you.